Castle Group's Regional President, Fiona DiDomenico.
Thank you so much, Gianna. Good afternoon, everybody, and welcome. Happy holidays. I think I can officially say that since we're now in December. So we thank you for joining us today. We've got some great experts. And for those of you that aren't familiar, I am Fiona DiDomenico, Regional President with Castle Group. And Castle is a local Florida firm, and we are privately owned, and we specialize in associations where we can put a team on site. We manage about 300 plus associations across the state of Florida, and we also manage some associations in Texas. So if we have anyone from Texas joining us today, welcome, and thank you for being here. We would love to help you out, answer any questions you may have, and so always feel free to reach out to us, and we'll help you out the best way that we can. So I wanted to get us going today. We've got Joe and Keith, and Joe, I'm going to turn it over to you to introduce yourself.
Thank you, Fiona. Hi, everybody. I'm Joe Thompson. I'm with Gulf Shore Insurance. I'm a partner and client advisor with Gulf Shore. I've been here about 8 years now. I specialize in condominium association risk. Kind of specifically, I do a lot of coastal risk, a lot of associations on the coast or on barrier islands as well. But that's really a focus of ours. We're a full service insurance firm. We've been around since 1970. A few years ago, we partnered with one of the top 10 largest global brokers, Acrisure. So we are an Acrisure agency partner, but we have a very large specialization in associations. We have partnered with over 800 associations, and that's essentially what I do exclusively is I partner with boards and property managers.
Excellent. Thanks for being here, Joe. We appreciate your expertise, and I know we have lots and lots of questions that have come in regarding insurance. So it's going to be, we're going to keep you busy today.
Great.
And Keith, turn it over to you. Welcome. Thanks for being here.
Well, it is 12:04, so good afternoon, everyone. My name's Keith Skorowitz. I'm a partner at the Appleton Reese Law Firm based out of Tampa. We're a full-service law firm that handles virtually all of our clients are community associations, condominiums, homeowners associations from southeast, deep in the heart of southeast Collier County, all the way up to Osceola and Orange County. So basically the I-4, I-75 corridor. This has been a trying time since March. We've got a great list of questions from the participants today. I think we're going to work well with Joe, get some of your questions answered. There's a great bit of overlap, and hopefully we can make this fun as insurance and condo law can be for you guys. So
it's fun for us. I mean,
we'll curl up with our declarations and our insurance policies and subparagraphs and get to it.
There you go.
I'm in.
Excellent. All right, good stuff. So what I thought maybe we should do, guys, is if each of you could just maybe take a minute, Joe, if you'd start us off, maybe just kind of give us a high level, and then turn it over to Keith, and he'll give us a high level, and then we can really jump into the questions.
Yeah, so I mean, on everybody's mind, the board members that are on or managers is obviously insurance cost right now. So we're in something that you've probably heard a lot of people refer to with respect to property. We're in a hard market, right? So this happens periodically over the years. It has in Florida historically, where it's a very cyclical cycle with property insurance. And it's really related to these natural disasters, e.g. hurricanes that we have to deal with living down here in Paradise. So if you go back a little historically, in the recent times of the years of 04 and 05, we had the really bad year for those of you that were here in 2004. We had the Charlie, Ivan, Francis, Jean. I don't remember if that was the order, but it was the 4 hurricanes that essentially hit Florida in one hurricane season. It was just devastating to everybody. And then, of course, 05 followed another bad year. We had Wilma, and then, of course, that was the year of Katrina as well. So what happened, after those, the subsequent years thereafter, for about almost 8 years, the property rates just skyrocketed. And it was just beyond belief, a hard market. People were paying just a significant amount of money for their property insurance. And it seemed like there was really no end in sight. Well, probably about 2013, it was about 7-8 years of that type of a market environment. The market really started to soften up quite a bit. And boards were seeing the opposite. They were seeing the exact, everything double-digit decreases, carriers providing enhanced terms and conditions and coverages. And it seemed like, wow, is insurance going to be free one day? Because it seems like we're paying an unbelievably low rate here. And the answer, of course, is no, it won't be free anytime soon. But what happened was that it was, the market forces were coming in and things were changing for the positive. But then, of course, we had the year of 2017. We had a 12-year stint of no storms here, which was an amazing run from 05 to 2017. But 2017, we had Irma, number of other storms. I think that was the Harvey year as well, which was unprecedented for the Gulf Coast and Houston area in Texas. And then 18 and 19 and 20, we've had all active years thereafter. So that's a big driver of a lot of what we're seeing in the property rates. And also a lot of these losses with Irma specifically, some of them are still open, where the carriers weren't anticipating these claims on the onset. And folks have 3 years to essentially file a claim after a hurricane event. And a lot of them waited for years to do that. So now these carriers have to reserve for more losses than they anticipated, which is helping drive up the rates. A lot of the reinsurers are charging more and the rates are going up for the reinsurers. So a lot of carriers are dependent upon a proportion of reinsurance depending on their financial standing, where they are, if they're rated or unrated. So reinsurance is a big driver behind that as well. But it's also just not isolated to us. It's global. I mean, there's all sorts of global events affecting, rates with property. Wildfires have happened out west. We've got civil unrest. There's a lot of things that have really played into it. So it's just really been the perfect storm for property insurance. And of course, for most condos in the context of a condo association and most HOAs, in some cases, the biggest line item is insurance. Unless they have a lot of employees and they're self-managed, it might be payroll. But for the most part, it's a huge line item and it's on the top of everybody's mind right now. And believe me, we're experiencing it as well because we work with 800 associations. So that was kind of the long-winded version of what's going on with respect to property right now.
Excellent. And Keith, would you mind jumping in and just kind of give us the same thing, high level from a legal standpoint?
Sure. High level, we're going to go with the 3 Ps today, folks: policies, planning, and projects. I think we could probably cover a lot of ground. I know that everybody's concerned about COVID, having meetings. It's a good time to really back up and do a health check of your association. What projects do you have coming up? And what policies and issues are you dealing with? And I want to share with you some of the things that I see as more and more folks move to Florida. I think I saw a stat the other day that something like close to 9,000 people a day are moving to Florida. Many of the snowbirds that come down, particularly those of you who are on the call today who are in our southern Gulf counties, you'll see the traffic is going to be there more often. People are staying. We're finding that boards are far more engaged. People are in their units more. So we need to address having policies to deal with all of those people there all the time. We'll deal with virtual meetings. How does that work? Annual meetings. How do we incorporate Zoom? What's the legislature going to do, if anything? And policies regarding social media. We're going to talk about the resisting the temptation. And finally, a little bit related to insurance are your projects and budgets. If you've got upcoming projects, whether it's a roof or it's asphalt or painting, if you've worked with your manager and done any of this research, you'll find that some of those contractors are stretched pretty thin. So I'm encouraging everyone to kind of, if they have not gotten a recent bid or they've got to go do that, you've really got to get out in front of your contractors and really do some serious project planning and working with your manager, because there are going to be material shortages as projects come online, and there's going to be labor shortages. I'm already seeing it. So again, today is going to be about policies, planning, and projects.
Okay, excellent. So with that, I think we'll jump in. We're going to start with an insurance question, Joe. So the first one we have asks us, at what level of insurance premiums do organizations self-insure? Can you speak to that a little bit?
Well, I mean, self-insurance, you have to think of it with respect to what the statute requires you to do in 718 in the condo context. You have to get an insurance replacement cost appraisal every 3 years. That's going to basically enumerate what the values are that you have to insure with respect to association property. So I don't know of anybody that is self-insuring. If they are, they're taking a tremendous risk. I mean, nobody's going to come and arrest the board for not insuring, a structure or two or what have you, but you run the risk from a D&O standpoint as a fiduciary of the association to essentially be sued if you decide to self-insure something and the wind blows or a fire happens or any kind of insurance event occurs and that structure or asset or what have you of the association is destroyed. and then you have to replace it. Repair and replace it is also part of your responsibility on the board. So if you don't have insurance to go to that, and the membership is not okay with a special assessment, well, what happened there? So, I don't see anybody doing that. In some cases, the policies, depending on what type of policy they have for the property and what level of a schedule they have, if they have multiple buildings and lots of ancillary property as well, they might be, by virtue of the policy terms, self-insuring something. For example, some property carriers have a minimum deductible of like $25,000 with respect to any wind or hurricane damage. So if you have a gazebo that's $10,000, well, if the wind blows, you're not going to get coverage because the minimum deductible is $25,000. So the board needs to be aware of that with respect to how their coverage might actually interact with potential areas where they are self-insuring and they may not even know it. A lot of property carriers will not cover boat docks, boat slips, anything associated with that. And some boards are completely unaware of it. The wind blows, or the event that we had, that tropical storm Eta. I had a client in Sarasota that they lost part of their boat docks because another boat floated down and rammed into it. So again, they knew that they weren't covered for that, and they had looked at an option to cover it. And it just wasn't, the premium was too high for the level of insurance for it, because it was about $150,000 for a few slips. And I think the premium was like over $10,000 a year. So they chose consciously to not insure that. So every circumstance is different, but a lot of it is related to the policies and you just understanding what your retentions are, what your deductibles are, and how all of that plays into what you're covered for and what you're not covered for. And a big piece of that is education, number one. So yeah. I don't want to be too long-winded.
I can tell you from a management standpoint, our guidance would be whenever we hear someone say they want to self-insure, I get uncomfortable.
Yeah, exactly.
And
right.
we always advise, okay, well, let's talk about it. Let's unpack this. And for sure, insurance agent on the phone with association attorney, with board, with property manager, because we got to make sure we understand, all sides of the coin. And generally, it's not a good idea. Would kind of be where I would lean.
It's education focused. And I mean, I always call it it's a risk tolerance question, because you can insure for almost any type of exposure. And there's a lot of policies that we know we have to have: your D&O, your property, your general liability, your umbrella, things that are, standard. But then there are some policies kind of on the outskirts of the spectrum that are things that would be more classified as a risk tolerance type policy. I mean, I use one as an example. It's called plate glass coverage, where there is coverage out there for first dollar coverage for the replacement of whether it's tempered glass or if you have pre-existing impact glass. You don't have to purchase that. But if you're an association that is fearful of, you say you're right on the coast, you're in a barrier island, you're in an older structure, it's all tempered glass. If a big wind event comes along, you're going to lose a lot of that glass. You're going to be under your 2, 3, 5 or whatever percent deductible you have. So you're going to self-insure all that glass replacement, because the glass is the responsibility of the association. So a policy like that, you can have the discussion about it, but knowing that if you don't purchase it, you will be self-insuring the glass in that type of a scenario. So there's a lot of nuances there and variables with respect to what is self-insured and how to control that. And I could go on and on, but I won't. So yeah.
Yeah. I want comments from a legal standpoint?
From a legal standpoint, the board does enjoy protection from the business judgment rule, but to the extent you're going to self-insure, on a high deductible, it's really, really important. It's critical, almost in my opinion, to go get the research from your insurance professionals. And I have it actually on my list of things to talk about. I said, do a health check. Take this time where everybody's got this time to get with your insurance professionals, understand what you own, what does it cost to insure, what's it going to cost to replace, and and these days, it's not just a named storm or a Greek letter storm. Here in St. Petersburg, we had a thunderstorm that was as powerful as some storms we've had that were named last summer. So it's important to get that research and to kind of button that up. If the association decides, like Joe said, to say, look, we're not going to spend $100,000 on some sub policy to insure some far out risk, but at least have the meeting, talk to your professionals, ask the questions, and put them in the meeting minutes, so that if someone comes back later and there is a catastrophic event, you can say, listen, we chose to do this for this reason, and you're virtually going to be protected. I too am like Fiona in unpacking the potential for purely self-insured. We have hundreds of associations under our umbrella, and I'm not sure any of them do that. I mean, you can kind of go with a hybrid with some high deductibles if you're trying to keep your costs down. But again, do the research, protect the boards, because you run the risk if you don't of having exclusions on your D&O coverage if you make a mistake.
Yeah, and my last comment, we're going to jump to another question that's come in, but on that note, sometimes I'll have a board say to me, well, Fiona, we talked with Joey, who is an attorney, and he's on the committee or he's on the board, and I beg you, please, as much as I love Joey, you have to go to your association attorney. Okay, we have a live question that came in. How common is it for master associations not to have theft coverage? Thoughts on that, Joe?
It's uncommon. I mean, if they have a budget, they need a fidelity bond policy, crime policy, which is sort of the informal way to refer to it. I mean, you need it in an amount that's equal to the amount of funds on hand at any given time plus your reserve is the, you know, how much it should equate to be. And you want to make sure that that policy covers not only employee theft, but, you know, forgery, alteration, funds transfer fraud. There's a new thing out there, social engineering, which has been talked about as another crime insuring agreement that you want to make sure you have coverage for. But it would be uncommon, and it would be a big exposure if it was a legal entity with its own FEIN number, the master that had its own budget. You absolutely need a crime policy. There's no question, or a fidelity bond policy for that association. Sometimes you will see, and I've seen this before, and I'm not a huge fan of it, where you have maybe a master and say there's like a condo within it or something, or a couple sub-associations where they have one policy and they name the subs as an additional named insured on the policy. Typically, I like having things separated, so I'm not sharing limits and things like that. But that's not uncommon, which technically you can be afforded coverage as, you know, another named insured on the policy, but you just have to be careful with that to make sure that all the coverage agreements would be in alignment with all named parties on the policy relative to how the coverage would be triggered. So that could happen, but just not having it, you're self-insuring. And back to the first question, which is a big no-no. Say there's some type of impropriety at the master level and somebody steals money, or money's wired somewhere and it disappears. How are you gonna get it back? I mean, you need insurance. So.
Absolutely. Okay, great. We're going to jump to a legal question, Keith, if you're ready. This is kind of a big one. It says, what legislation will have the greatest impact on HOAs looking into the future? Do you have any thoughts on that?
So the legislative session doesn't start till the second Tuesday after the first Monday in March in Florida. Last year, I think we tracked something like at least 18 bills that had multiple hundreds of subparts that would have affected associations, both condominiums and homeowners association, and one made it into law. That was the very minor part of the law that allowed police officers and civil servants who drove trucks and cars into HOAs. That was the only thing that passed. So that kind of dovetails, Fiona, with some of the things you and I have discussed in the past about how are we going to do, let's look at the big picture. What everybody's concerned about is how do we conduct meetings? There is a movement among the circles that I run in and the lawyers and the legislators to push forward some sort of a bill to kind of help associations deal with this. But having seen the legislature, I'm reading tea leaves here, folks, having seen the way that they react in past years, I'm not convinced that they are going to make it substantially easier for associations to operate. If the current political climate extends down into Tallahassee, I just don't, that might not be their top priority. They may have other things that they are dealing with. So while it's super important to us in our real estate world, I don't know that the legislature is going to make any sort of substantial improvements, but that doesn't leave you without any options. And that goes to my policies portion of this. You can address some of these things with new policies, whether it's how you're going to hold the meetings or amendments to your declaration and bylaws to permit those types of board meetings and fill in the holes with, you can do things virtually. So I am not, long-winded way of saying I am not convinced that the legislature is going to make any substantial changes or to try to help associations in the next legislative session. I hope that I'm wrong, I truly do. But if you have certain specific issues to your association, get with your lawyer, get with your manager and find out what they are and find out what you can do to take control, whether it's an amendment or pass a policy or make a new rule to deal with some things that you're dealing with. So if there's a specific question, I'm happy to answer it. I just don't know that they're going to get there. And I'm on a...
Yeah. So I think the question we talked about a little earlier was it's revolving, participation for board meetings and membership meetings to include video conferencing. And I had a question come up this morning, which is, if you're doing an annual meeting and people are on Zoom, can that count as quorum? So it's those kind of questions that are coming around. What are your thoughts on that? And I know we talked a little bit, maybe you can comment on the voting part too and making sure that that's on Zoom.
So I think it's going to depend on the association and the size, Fiona. I think sometimes practically speaking, I'm going to go safety first. If safety first and participation, if there are cameras set up and people can observe, I'm always in favor of giving people the opportunity to appear and vote. And if it's virtually, so be it. I just don't think that can't land back on the board if they let someone participate, especially in this environment. I haven't seen any pushback on doing it that way. Now, having said that, when you have an annual meeting, you are supposed to have it in person. It's required. So the managers and the lawyers are really in a tough spot, and the boards are in a tough spot. But I think we've kind of threaded the needle. We've learned a lot over the last couple of months in terms of doing a hybrid. If you've got a clubhouse, limited participation, counting the ballots under the camera, and ask your manager. And if your manager can't help, develop a plan, because a lot of it's going to fall on your management company to implement a plan to hold. And this, let me be clear, this applies to annual meetings as opposed to just regular board meetings. Annual meetings are turning out to be tricky because you've got to do the proxies and you got to count the ballots. So unfortunately, there's no black and white answer.
Yeah. And what we're finding from a practical management standpoint, so everyone listening can understand, is one, we're sitting down with the board and developing a written plan and getting the association's attorney involved, because everyone's documents, are different as well. But for a good portion of the associations, they are, when they have the room to do it, they are offering some in person for the annual meeting. And we're doing like a reservation type scenario. So if the room can hold 200 people, we're determining how many people can the room hold socially distanced appropriately. And, maybe that's, I don't know, I'm making it up, maybe that's 70 people. So the management team goes in and they figure out exactly, the spacing of the social distancing. They make it very clear that masks are required. And then they say to the residents, we're going to accept the first 70 people that register to come, and everyone else, can participate via Zoom. Some associations are doing it also outside, by the pool or whatever it may be if they have the space. So definitely we're getting creative and trying to make it as inclusive as we possibly can make it for everybody. And for actual elections, for sure, making sure that is videoed so that everybody can see as if they were there in person. We're having to get, creative on that. We have another question from an insurance standpoint, and I'm going to kind of throw a couple of these together, Joe, because they're really around rate increase.
Okay.
And so, everyone's hearing, hey, insurance rates may go up 25% in 2021. Right. Is that correct? Et cetera, et cetera. Maybe you could speak a little bit to what you're seeing in the market and what the differences are between someone's rates who go up, 5% versus, 20%.
Sure. So the budget guidance that we had kind of promulgated out to our clients was a spectrum of, again, because every property, every building is so unique, and the variables associated with those are also unique. And a lot of that ties into the underwriting criteria and what the underwriters look at, how these properties model, where they are geographically, the age of the structure, the age of the roof, the opening protections, prior claims. There's so many factors that go into it. So I can't give you a singular number because every risk is so different. But the spectrum we gave was between 15 and 25% is approximately the spectrum. Now I've seen thus far, because we're getting into kind of what we call renewal season for us, is after hurricane season, the busiest time of the year for us for renewals is December to May outside of hurricane season. So some Decembers that we've already renewed, we've seen anywhere between, at that 15 to as high as 25, 30. But I've also had some that were flat and below 15%. So again, it's very dependent on those factors. I mean, if you're on a barrier island you were built in 1970, you have an old roof and you have no opening protections and you've had claims, expect a 25 to 30% increase. There's no question about it. Now, if you're farther inland, maybe you're in a fire resistive, newer tower that's fully mitigated, structurally connected roof. I mean, you're looking more at the 10 to 15% range, depending on the carrier that you're with, because there's more options in that scenario. The problem that we're running into is that because the market is hard, carriers are less apt to want to give all of these enhancements and wanting to compete. So some of them are just changing their underwriting criteria and saying, look, we're not quoting anything on the coast anymore, period. So you're in a scenario where, from a competitive standpoint, when you've hired that one agent to go out to this finite number of markets out there that actually quote these types of properties that are these large condo associations, the pickings are slim on some risks because you're with potentially the one carrier that is pretty competitive. But when that carrier gives you a 30% increase and the agent comes in and says, well, this is the best that there is in the market, it's hard for boards to accept that. But in some cases, it may be the case. That might actually be accurate. But in other cases, because of the different criteria that I mentioned relative to the buildings and how they model and where they're located and the histories, it could be a lot better. And there could be more carriers that would step up to the plate to actually quote it. So when that happens, we're able to leverage those against one another and create competition, which drives down the rate, gets better enhancements, better terms and conditions, but only when there's competing carriers involved. When there isn't a competing carrier, and we know that, say, for example, the incumbent carrier is the most competitive, it's difficult to get any other alternative because it's a pure competition piece. There aren't any other alternatives. So again, that range is a pretty good range to use, but no, there's a lot of variables that are in that spectrum that would either drive you at the lower level of the spectrum or to the higher end. So it's not a 1% answer for everybody. There's not a one size fits all ever.
Absolutely. And our best practice from a castle standpoint is, when the managers are preparing, their budget drafts to submit to the board of directors for consideration, is they reach out, to every vendor, including the insurance agent, to say,
right.
Hey, what does our situation look like specifically?
Yeah, we try to be
always
conservative.
Yeah.
We try to be conservative with the estimates. I don't want to ever, under promise and undershoot where I think things are going to be, but we do look at it case by case, risk by risk to really assess it and, base it off of what else we're seeing with comparable properties and renewals that are going on. So that's always a helpful indicator, with some December renewals that we've been seeing, what they're coming in at may or may not, but hopefully may be an indication of what might happen further into 2021. But there's other factors out there, like a lot of reinsurance treaties are being renegotiated on January 1st. So a lot of insurance companies are gonna have to pay more for reinsurance. So that's a factor that we're not anticipating that will be going on. But again, it's a very specific analysis, property by property, and it's hard to just blanketly state to somebody, yeah, everybody expected 25% increase. It's not true. I had a carrier that an association we partnered with in November, and we had done a rate analysis for them. It was a prospective client, and they were already paying well over what the market rate was for property, which was very strange. So when we partnered with them, we were actually able to negotiate them a very close to flat renewals, a 5% increase, which is unheard of for a risk that's on a barrier island that's in an older association, but that was a unique circumstance. So there's outliers like that out there too. So It's a very case by case basis.
Great. And then Keith, we've got a couple of questions coming in regarding COVID-19 coverage for insurance. So before I have Joe speak to that, do you want to speak a little bit to what the association should be doing, to protect themselves legally with their amenities? And you mentioned, a lot of snowbirds coming back into town that have been gone.
That's really from a practical standpoint. You can get with your lawyer to develop some policies. It depends, and again, to kind of piggyback off of what Joe said, it really depends on the association and your existing documents. I like to say, and Fiona's heard me say this, each association is like a snowflake. They're all different. So it depends on what you own, how long you've owned it, what kind of assets do you have, pools, bathrooms, clubhouses, restaurants, common areas, condominium towers versus a mid-rise with outside doors. All of those things come into play. But let's talk big picture. If you've got common areas, you should absolutely have some sort of a policy in place. Either you're going to clean it or you're going to put up signage that people do it at their own risk. You want to attempt to try to follow CDC guidelines in terms of spacing and how it's open. If you've got a particularly popular amenity, get with your lawyer and get with your manager and develop a plan. I have a client in Naples that needed to do training for some of their boats so they could be a quote unquote boat captain so they could get their rentals out, and they were chomping at the bit to get it done. So we worked with them to develop a policy for cleaning and signing in and signing out so that it can be done safely. Really what you want to try to do is you want to be reasonable under the circumstances. We want to be reasonable. So again, it depends on what you own, but some of the things you might want to think about is amending your declaration to put a COVID disclaimer in there. It's not a shield, but it's something you could consider. I don't believe that COVID is going away anytime soon. So this isn't really in the beginning, it was temporary. We were responding. It's no longer a temporary thing. We're now kind of we know more. I think it's going to continue. But again, I hate to keep sounding like a broken record, but you got to have policies in place to address all of the different things you are doing. Signage, how are you managing the situation, working with your manager, pools, common areas that people are using. So for instance, if you have a ping pong room or a billiards room, and elevators is another one. Are you doing spacing in the elevators? And I'm sure, Fiona, we have under over 450 associations that we manage at our law firm, and they're all very different. And it just depends on what the tolerance of risk is for the board to deal with those different types of issues. But again, have policies.
It's a great point, Keith, because obviously, we have some associations that might have a community pool, with a cabana. So there's no, real clubhouse, and they've never had any staffing per se in those associations. And then you've got an association that has, a community pool and a clubhouse, and there's staff
Right.
in the clubhouse. And so, the expectation level from the residents is higher where they've had staff. So that's why it's so important. Again, just like Joe was saying with insurance, it's not one brush,
Right.
here, do this, and it applies to every association. It really does require to sit down and really take a look at it with your management team, and then get the association's attorney to look at it and really bless the plan from a risk standpoint.
That brings up a really
it's
good
well
point,
worth the money.
Fiona. For those of you on the call who have staff on property, those staff are typically, I'm just generalizing here, typically employees of the management company in which the association has contracted with. And they have their own policies in place to keep their employees safe. Remember that the employer has an obligation to keep provide a safe workplace. That workplace may happen to be on the condominium or HOA property. So you really have to have a good, tight relationship with the management company to understand what are they doing, and then what is the association doing to keep those folks safe. That's been a large part of our practice, is advising on what do we do with all these employees that are employees of Castle, but they don't go to Castle, they come to XYZ condominium association every day. So what are we doing to keep them safe?
Yeah, absolutely. And I have to give a shout out to any of our board members who are joining us today, because you guys have all been phenomenal partners, and we thank you for that from the very beginning. Extremely receptive. Castle put together a whole COVID, plan on what to do if an employee is exposed, if an employee tests positive, if a resident is exposed, if a resident tests positive. And I got to tell you, in the first early days of COVID, we were having emergency board meetings. It felt like constantly. And as things are starting to ramp back up, we all know the numbers are beginning to rise again. We are back at Castle to meeting with our teams. We've got a call with them next week, all the property managers with Rob Donnelly and the owners of Castle. So we're ramping right back up again. So we'd be happy to share that playbook with anybody who doesn't have it. It's all about keeping everybody safe and informed, really, from a resident standpoint. So Joe, on that note, if you want to comment a little bit, we've got a couple of questions that came in, and they're really asking about, is there any insurance coverage regarding COVID-19? Can you kind of speak to that a little bit?
Yeah, so there's a couple components to it depending upon the exposure. So if, Keith had mentioned, we're looking at associations differently. Say you're an association that has like a food and beverage exposure or a high rental exposure, and you might have a loss of income issue with COVID. You could look at it from a property standpoint, saying, oh, well, we have a business interruption limit. I would presume because of COVID and things have been shut down, we can file a claim for that, correct? Well, no, because most property carriers include standard form exclusion for a virus. So on the income side of it, there's an absolute exclusion, and a lot of that is actually being litigated by restaurants as well in the retail industry right now. But generally, it's never been covered, and likely you're not going to see any coverage on that. The second piece of it would be bodily injury. So the fear of, what if somebody comes to the clubhouse or goes to the fitness center and they say they contracted COVID on site and they blame us, where's our recourse? Where's our defense and indemnity there? Well, for the most part, you would go to general liability because the D&O has an absolute exclusion for bodily injury and for property damage. So D&O would never cover any instance associated with somebody being sick or ill or dying. So you look at the general liability and you look at two different levels of things. One is you look at the carrier-specific exclusions, because every carrier has their specific exclusions embedded in the policy. Some carriers have a communicable disease exclusion. It's black and white, and that's in the policy. Obviously, there's no coverage. They've written it in there to make sure that it's excluded. Some define pathogen. Sometimes pollutant could be defined or interpreted to mean that there's no coverage for that type of a piece. But in every adjuster that I've talked to, especially when this started happening, we would ask that question, like, well, what would you do? Because we have a number of policies that are seemingly silent to the fact of, is there any coverage for virus or for COVID? I don't see anything in the policy that would really preclude that coverage. I've asked this question quite a bit. And the feedback I've been given from the adjusters, because there really is no precedent here. There's no adjusting precedent. We don't have any claims for these. I can't tell you what the outcome has been if there's ever been a claim in the context of an association, but we haven't seen one yet. But the adjusters have told us that, again, confirmed, and we knew this, there's a standard exclusion in every general liability policy, what they call the ISO or the ISO Insurance Service Office exclusions, that they basically do all the boilerplate policy language for most standard policies, and it's called an expected or intended injury exclusion. So the thought is that if you were to file that type of a claim with a policy that didn't have an overt exclusion for communicable disease, the adjuster would point to the expected or intended injury exclusion and deny coverage based off of the fact that we're in a global pandemic. This is an expected injury. So to answer your question, there is no coverage in that circumstance under general liability or D&O. There is a policy out there that's gained a lot more traction. And again, it's been unfortunately framed as COVID coverage, which it is absolutely not COVID coverage. But there is a defense-only policy available for boards to purchase, so they can actually buy a policy that would pay defense costs only for any claim that was filed that wasn't covered by other policies. So say you file that claim, D&O declines it, which we know they will. You send it to general liability, they decline it. You could send it to the defense-only policy, and they would provide hourly defense through an attorney of their choosing to defend you, but they will pay for nothing else. There's no indemnity, there's no settlement, there's no expert witness fees, there's no mediation costs, court costs, et cetera. So to some level, some boards have looked at that as a kind of a buffer. Well, at least this is something we can defend and go prove that this didn't happen here, because attorneys that I've talked to, and Keith can confirm this, is that it's going to be very difficult for you to,
Right.
Basically say the causation of me going into a clubhouse and contracting COVID, where was I for the rest of the day? I mean, it's almost an impossible argument to win there. So you could consider that coverage. And then there has been coverage out there, and I was kind of working with a particular carrier that's actually based out west on the first communicable disease policy for an HOA that we were working on to put into place. And it was a very expensive policy. It was a $50,000 a year policy separate to their general liability. And unfortunately, this carrier doesn't use the standard policy forms that we're all used to. They have what we call a manuscript form. So they write it however they want to write it. Their lawyers write it however they want to write it. So it was very, very strangely written, and we were concerned that the way it was written, that it wouldn't actually cover them in the event that something would happen. So there's that fledgling piece out there, but it really needs more to happen in that space for that to become a conceivable product for people to consider, because from a cost-effective standpoint, it's just not there. But generally, nobody has coverage.
50,000 is pretty rich for a maybe of coverage, right?
Oh,
So,
absolutely. Yeah. They had originally indicated to us that the policy could be as high as 200,000. So you can see where
oh my goodness.
it's just not conceivable. Yeah.
Gotcha. Keith, any comments from the legal standpoint? And then I do have a question that's come in that I'm going to dovetail in here.
Yeah, no, I'm not going to carry on. Joe covered all those bases.
Okay.
I think
Covered
it's
it.
really important
Okay.
to just keep in touch with everybody. Again, a little bit of that goes back to policies and being reasonable. You can't just ignore the pandemic. If you're not going to be cleaning certain areas, let's have a policy that we're not, and let's post it and get some signage, because that's being reasonable. It's about the reasonable person.
Got it. Okay. So Keith, for you, we've got a question that came in, and there was a couple earlier. Essentially, this is around if a board member does not follow the attorney's advice and goes against the recommendations that the attorney has given, are the board members then not covered by the D&O coverage? That one has been coming in, that question came in live, and then we had another one that came in very similar to that. So if you'd speak to that for a little bit.
Sure. The board has, again, I mentioned this earlier, the board enjoys the protections of the business judgment rule. What that means is that they have to act reasonably. They don't always have to be right. Boards can rely on experts, accountants, lawyers, engineers, insurance folks to get advice. They're free to disregard that advice. They can do so. And it doesn't necessarily mean it's going to be excluded. And it also depends on the issue. So for instance, if you're taking some sort of a risk that involves substantial probability to damage to property or personal injury, and you just ignore that advice, it's potential that it could be excluded from a D&O policy. I'll let Joe talk about perhaps some of the more intricate details of the D&O coverage, but from a reasonableness standpoint, from the legal standpoint, it just depends on what the issue is that you are facing and you're ignoring the advice on. So for instance, if your accountant says, and this applies in the same way, if your accountant says, listen, the tax code requires you to do X, Y, and Z, you've got to do this, and they ignore it, well, they're going to do that at their own peril. So and that's a different issue than whether or not there's coverage. It could be excluded. Joe, do you want to jump in on kind of dovetail on that?
Yeah, well, I mean, you gave two perfect examples. I mean, if there's anything, a decision that there's any potential for bodily injury to result from the decision, and they disregard, your advice or your counsel as an attorney, it's not going to be covered if somebody gets hurt, because bodily injury is excluded by D&O. So that's going to have to go to general liability if that person's hurt. And then the board's going to be left exposed based off of that decision that they made. Or if there's property damage associated with it, D&O doesn't cover any property damage related claims either. So now if they just totally disregard, your counsel on some tax issue or something, to your point, generally, I don't know that would be excluded. I mean, because you mentioned the business judgment piece, I know intentional acts are excluded, like something criminal would be excluded. But that I'm not so sure. I'm pretty certain they would get defense and indemnity, but I would probably want to bounce, if there's a specific question about that, I'd want to bounce that off of one of the D&O carrier underwriters. And a lot of the D&O policies, and boards should be aware of this, they come with a free legal hotline. A lot of these carriers offer that, where you can actually get advice for free as a policy holder from the D&O carrier's preferred law firm through whatever 800 number they give you, and you can give them hypothetical D&O claim scenarios, and they can actually give you some counsel on it, and you don't get charged anything. So that's kind of a benefit of being a policyholder, and a lot of boards don't even realize that exists. So sometimes that can really help, because these questions do get very legal in scope, and some attorneys may not know the particulars of your policy, where you're dealing with, say you're with Great American on D&O, well, they might have a lawyer on staff at this, place that they use, that's all they do is D&O litigation with Great American. So they might have a good precedent of cases that could potentially be of use, or, as an example to what you're wondering about.
That's a great tip. Thanks for that, Joe. So Keith, jumping back to you, we've got a very specific question that came in, and it says, has anyone filed their rules and regulations with the clerk of court?
So that's a great question. The statute was, there's a giant, in Chapter 720, let's just talk about homeowners associations. Chapter 720 defines governing documents to include rules and regulations. So we tend to err on the side of, yes, get the rule and regulation passed, especially if it affects the use of the property, or if it touches and concerns the real property. It's very cheap to record it, and it's a cheap insurance policy. So if someone complains that it's not enforceable or that they didn't know about it, you put the world on notice, you record it, and you take care of it. To go back to the issue of what's the legislature going to do, this is a hot button issue in the community association world with respect to governing documents, because it's an extreme burden to continue to record in the public record all these amendments to rules and the governing documents. But I tend to be pretty conservative, and yes, I do record the rules and regulations, particularly any changes, because the statute requires it. And it's just not a fight I want to have with a homeowner.
Right. Okay, excellent. And another specific legal question: is there any recent legislation passed clarifying requirements for 55 plus communities?
Not that I'm aware of. The 55 plus has, first of all, the 55 plus designation comes from both the state and federal level, and there are all kinds of exclusions and percentages and fractions and implementation issues, but I'm not aware of any recent changes to that. But if you have specific questions, for those of you who have that question, you live in a 55 plus and you've got a question about that, I encourage you to get with your lawyer, get with your manager, and ask a specific question, because it's going to depend. They're not all the same. They're like snowflakes. They're all different.
Yeah, and I can tell you from a management standpoint, the questions we often get is, documenting, how many people are, in the household are 55 plus, and do you have to keep the forms? Do you not have to keep the forms? So to your point with the snowflakes, right? we definitely. Yeah, it's perfect, right? It's very effective.
It's a perfect explanation.
Yeah. We sort of have a general, best practice around that at Castle, but for sure, as with anything, we have to check with the association's attorney. So measure twice, cut once. Let's all stay out of trouble, right? That's our goal here.
Yeah, there's all kinds of privacy issues with the forms, and then who's living in the unit versus who owns the unit. It's a record-keeping nightmare too. Sorry.
Yeah. We had another question came in regarding insurance, Joe, and I'm just trying to find it. Oh, here we go. So they're asking us, why do some insurance companies pay loss assessment claims quickly while others require much more documentation / pay really slowly? I know that's a broad question, but maybe is there some best practices that you see?
First would be just a discussion briefly on loss assessment coverage. This is apart from the association's insurance. This would be within the HO6 policy that a unit owner would have in the context of a condo association. Typically we would see that, or any personal policy where the associations experience property damage from a peril like a hurricane, and there is hypothetically a special assessment to pay the deductible or the underinsurance costs. And most carriers, by law, they have to have at least $2,000 of loss assessment coverage offered in the policy. So you can only get loss assessment coverage as a unit owner if your policy has wind coverage. If you have what we call an X-wind policy, which I do not recommend, and you're just covering for all perils and for liability only, you cannot get loss assessment. So that's one thing to note. So if you do have that situation, and then the association does this assessment, it comes in, it's a $4,000 assessment to every unit. Hypothetically, you could get that cut in half by filing that with your personal carrier. They would pay the $2,000, you would pay the other $2,000. Now, there are some personal lines carriers that go much higher in loss assessment coverage, but those carriers have very strict appetites for what they want from an underwriting standpoint. These are companies like Chubb and Pure, AIG, Cincinnati. They won't write middle market type condos that are smaller. They want the bigger high-rise type units that are the 4,000 to 6,000, 8,000 square foot units. And those folks can get as high as $50,000 in loss assessment based off of that. So to answer their question on the speed of how quickly claims are processed, every carrier is going to be different, unfortunately. And a lot of them are under a lot of stress. I mean, obviously, the loss assessment happened a lot after Irma. There was a ton of those claims, and they were being inundated, because there were so many special assessments. So when there's a backlog of those, sometimes that can explain, administratively why the claims aren't being processed as quickly. And then, of course, as more claims come in, the more stringent the carrier gets in reviewing everything, because they're like, my goodness, we're paying out quite a bit here. Let's make sure we're looking at everything very closely. So then the process can slow down considerably. In that case, and we saw it after Irma, that happened quite a bit, where claims had trickled in. I mean, the carriers were already overwhelmed when that happened. And then with Harvey that year, that actually hit the Houston area. And that was an area where a lot of those carriers were headquartered. So one of them, their headquarters was underwater. So, I mean, those types of things are factors, but a lot of those companies were understaffed. prior to that year of that terrible hurricane season. But now that we're sort of back in hurricane mode because it's been going on so much, the company's really learned a lesson, and now they're fully staffed, and most of them are very, very efficient in getting quite a bit better in the process with claims handling.
Right. And so what would be the best path for the property manager or for the board who's working through that issue? Is that a reach out to the agent?
Yeah,
Is that a reach out directly? Yeah.
Good follow-up question. So, with us, I mean, every agency is unique. Our firm, we have a claims staff internal. So we have licensed claims adjusters on our staff that we call claims advocates. So if their agent has that type of a resource internally, they absolutely should be utilizing that and using that claims advocate and that agent's staff person who is on your side, right? They're a member of your team, because the actual adjuster for the carrier is the fiduciary agent of the carrier. They're really not looking out for you as the insured. That's not their job. Frankly, their job is to find a way to not cover you. So if you can locate some level of advocacy from your agent, or if they don't have a robust claims team, just really get on the agent about helping out with that process. That's what I would recommend. Unfortunately, in the personal line space, it's very much a volume sort of business. So in some cases, the agents, they write the policies more transactionally, and it's really there's not much help that people get personally, which is very unfortunate, as opposed to associations where it's all relationships and it's advisement and risk management. So I would recommend they reach out to their agent for some help on that.
Excellent. And then Keith, jumping back, we're getting close to the end of our time. If there's any more questions from the audience, I encourage you to type them in now, and we'll do our best to try to wrap them in the last few minutes here. But Keith, we have a question it's actually regarding insurance, but I think it was more of a legal. It says, other than the president, which board member should be responsible for advising what insurance is needed? That's kind of a loaded question. I'm not, there's probably more to the story would be my guess, but at a high level, can you kind of speak to that?
The direct answer to that is it's not the board. Go see Joe or someone like Joe. There can be a committee, of course, or your manager can go investigate who's going to give you the advice on what types of insurance you need and the types of policies that are going to be best for your particular association. Certainly, you could have a board meeting and you could charge the vice president or any of the directors or any of the other officers to go do that research. But again, go get a professional to come to your meeting, whether it's virtual or not, and get the questions asked and get it answered, and have your manager take good minutes so that you were educated and you went through the process of understanding what kind of insurance you needed. So the question was a little bit kind of big picture, but consult with your professionals. You wouldn't try to fix a set of stairs without an engineering report.
Right. If I can add to that, I think to your point, Keith, is, document. A lot of our larger associations, or even some of our smaller ones, will have insurance committees because there's somebody who's been, in the industry and has a wealth of knowledge, which is phenomenal. But the manager should be documenting via the meeting minutes that the insurance agent, not this resident, has given all of this guidance, right? The committee's gone out and done the due diligence, but it's the agent giving the guidance ultimately, and that documenting that is important. Joe, you see that all the time. Any other comments on that?
Yeah, I mean, again, to use Steele Keith's snowflake example, they're all different. The setup, in some cases, the relationship on the insurance side is I work a lot more with a general manager, and then the manager, makes recommendations or, meets with a committee or the board. In some cases, I work directly with board members, whether it's the president, sometimes it's the treasurer, sometimes it's an insurance committee. So every association has a different setup for how they kind of, what I would classify as, handle the insurance and the relationship with the agent. I would always recommend, and I'll say, clients that I have that have an individual, whether it's a committee member or a board member that has an insurance background, I love that. That's the absolute best situation, because they can speak the language and I can communicate easily with them, and then they can communicate everything to the board very easily as well. So if you're an association, you're a board of directors, you could do a call for a committee of one. I don't know what the law is on that. I mean, look for anybody in your association that has an insurance background or was an insurance broker in their career or something, and they would be a big help to be somebody that could, at least review the insurance with the agent and then help make a recommendation. But if you're unable to do that, forming an insurance committee is a very astute way to do it. That way they're getting a formal recommendation, and they have people that can get more down in the weeds with the insurance, and then the board can, kind of discuss the high level pieces of it. But a lot of clients, I do work with a board president or a treasurer, one or the other, or both in some instances. So the setup is a little bit different, but generally there is somebody that's kind of designated as, this is the insurance person on the board that's going to handle this. It's very rarely the entire board involved in that process.
Right. Okay. And then Keith, we have a follow-up question to the annual meeting scenario we talked about. So it says, did Keith say that it must be held in person, or is it possible it can be held 100% remotely?
Chapter 720 contemplates that an owner has the right to appear in person or by proxy. So the answer legally is that you can't hold an annual meeting 100% virtually. You've got to have some place, and that's also based on most sets of bylaws that I've seen. So because the way that the statute's written, it doesn't contemplate a complete virtual annual meeting. That doesn't mean that it's not happening 1,000 times a day across the state. I'm realistic that it is happening, and to the extent that it's occurring that way, and lots of major management companies are doing it that way, it's about the process and getting with your manager and having the hardest part. In fact, Fiona and I were just talking about this, and this is across the spectrum, is ensuring that people have participation. So if you can get people to participate, I encourage everybody to participate via proxy, because then you don't have to worry about them being there. But if they're dead set on showing up and you're going to do it virtually, you've got to have a camera. I think my opinion is you've got to have a camera set up and a policy and a procedure in place so that people get their time to speak if they choose to do so.
Yeah, and I can just add to that. I think the spirit here is you don't want to hide behind COVID, right? So
Right.
You want to be safe, but you also can't just say, oh, well, there's COVID, so we can't have any board meetings and no one can come to an annual meeting. It has to be, it goes back to reasonable. I'm not an attorney, but I've spoken to many of them, more than my fair share in the last 6 or 8 months with COVID. And that kind of seems to be the overriding issue. And you're right that it's happening across the state, and it depends, again, on what's going on. We've got some counties that are almost at a 15%, positive testing rate right now. We've got other counties that are at, 3%. So different scenarios, right? So again, our guidance here is put the plan together and then check with your association attorney to make sure everyone's comfortable with what it is that you're doing. Guys, we are out of time. The time always goes by so quickly. Any parting thoughts, Keith, before we go?
I just wanted to say thank you to Castle and to those folks behind the scenes. Fiona, thank you for having us. Joe, great partner.
Absolutely.
If anybody has any follow-up questions that are specific, I always offer up. Fiona will share my email address. You can email me or call me, and I'll do the best that I can to try to steer you in the right direction. Even if you have another lawyer, I'll try to get this right for you, because I truly believe that we're all in this together, and it's going to take a plasticity of the mind to get through it and be creative. Thank you.
Right. Thank you. Thanks for being here. We really appreciate it. And Joe, any last words?
Yeah, thank you very much for having me. And I would echo Keith. I mean, if there's anybody that has any specific questions you want to reach out, contact information you can obtain right here. And I'd be happy to counsel with anybody, with a board member, manager, coverage counsel, take a look at where things are at. We're always happy to do that. And again, thank you to Castle for putting these on. These are very informative. And I know right now it's a tough time to be a board member, but board member is a very thankless job, but it is an important job. And I'm sure all of you are doing a fantastic job at it. So thanks again for taking an hour today with us.
Perfect. Thanks, everybody. You guys are always great co-hosts. I appreciate it. You make my job super easy. Thank you to audience for being here today. Any questions at all, just reach out, info@castlegroup.com, and we will make sure that Keith and Joe get those questions, or if they're for us, we'll follow up with you as well. So if we don't see you before the holidays, happy holidays, everybody. Stay safe out there. Be patient and be kind with your neighbors. We'll talk to you soon.
Thank you.
Bye.